And welcome to this webinar. You're here today with Ron Williams, technical strategist from MIG Bank. Let's kickstart the session. This is an exclusive session from MIG Bank, based in Switzerland, in association with FX Street, and the topic is profitable Japanese candlestick trading strategies. The slide that you're looking at is alluding to one that I did a while ago. And in this session, basically, we're going to be focusing on many things in a very short space of time, as is traditional. And before I actually start into the session, so FX Street team, just give me the heads up to start. I just want to share with you just some general details, contact details, should you wish to contact me directly with any questions, or even follow our work here within the research team at MIG Bank into the future. So my email address is r.william@migbank.com. MIG Bank also have, just one second, also have Facebook, Twitter accounts that you can follow. And you can follow a lot of my comments, which I'm now actively updating on forexstreet.net, the kind of network website which FX Street has adopted over the last time period. Okay, so I'm going to launch into just a quick introduction on myself. Those of you who'd like to know more details about my background, please feel free to read my biography on the FX Street website, which maybe would have been shown to you by the FX Street team, or the biography found on MIG Bank website. The key things I always like to focus on at the beginning of any kind of presentation is what tools I use on a day-to-day basis. So what is critical to me every single day when I look at the market. Okay, so basically the three things that I look at on a regular basis, and I have done for over 10 years of being in the market, is number one, market cycles, i.e. the relationship between price movements and time, or price movements over time. So this is actually just looking at market timing, but then looking at short, medium-term, and long-term cycles and how they impact each other. But also it looks at maybe intermarket analysis, where you can see how different asset classes interplay and correlate with each other. And that can be quite interesting in drawing out important themes, especially over the last few days, weeks, months, and years, ever since the financial crisis. Second thing that I look at on a regular basis, and I have done actually from the very start when I got involved into the industry, is pattern setups, pattern trade setups, and specifically Japanese candlestick trade setups. And what I mentioned in my previous presentation, when I actually began in the industry, working under a chief strategist in a economic consultancy, one of the first tasks I was asked to do was to actually draw out historical price data, open, high, low, and close, on a graph paper. And some veteran or kind of well-known technical strategists started that way many years ago, and some other more recent analysts like myself and a few others that I know were given the opportunity to start that more traditional way. And basically what I would say is, any of you who would really like to get a good understanding of the markets, aside from trading and analyzing the market every day, that's obviously the best way to really get to know the markets well. But in addition to that, I would probably suggest actually making some time just to do the very kind of simple traditional exercise of just drawing out price data just for a few days or for a few weeks, just so you can get a real understanding of the price movements. So a lot of my focus was looking at, charts generally, but specifically candle charts, and there were many reasons why I started to love candlestick patterns, but then also found them very useful in actually timing market turns, and obviously having a profitable strategy to use for so many years. Last but not least, DeMark indicators. Now this is quite an important area that I focused on in the very last few years, and this basically focuses mainly on counter trade indicators designed by a well-known investor and trader called Tom DeMark. He's a man that I worked with for a few years while I worked at Bloomberg Financial Data and News Company. And while he was developing his indicators, we were obviously learning as much as possible about them while we trained clients around the world on these indicators. And one of the reasons why I really like these indicators a lot is that they are market timing indicators. They adapt to volatility, and they're very precise indicators in that they tell you on this day, on this week, there's a particular turning reversal signal in the market. And then I look at various proprietary strategies in addition to all that. So these are the three areas that I look at on a regular basis: market cycles, Japanese candlestick trade setups, demand indicators, and proprietary strategies. Keep in mind that the next webinar that will be featured in August, the FX Street team will probably put the link in at some point. It is on the FX Street website, but the next webinar in August will be on DeMark indicators. So for those of you who would like to know more about this proprietary strategy, I'm more than happy for you to attend that session next month in August on DeMark indicators. Okay, so let's start. What are we going to cover today? So these are the three areas we're going to cover in the first session. Keep in mind there are two sessions, one which is free for everyone, and second one which is part of a FX Street premium kind of offering. And so for everyone that's here now, welcome. If I can just get a quick vote, just a quick feedback. How many people have attended previous webinars which I have given? So I've been giving them webinars at FX Street now for just over 5 months. How many people have attended previous webinars that I've given? If you could just say yes, me, hello, nice to be back, or any kind of confirmation. Okay, and so a lot of people are saying yes, and some people are saying no. So those of you that who are attending again for the first or second or more times, welcome back. We'll really try and encourage people to continue to attend the webinars that we give here at MIG Bank. Education is really important, and I believe personally I believe it's very important to share information that may be useful, especially during these market environments. And to some of those people who are maybe here for the first time, again, welcome. Thank you very much for making the decision to attend. And I really hope that for your first experience here in this webinar with me, at least, I hope that you really enjoy it and again, find it useful. For everyone, if there's any questions throughout the seminar, please, just ask, throw in the chat question. I will try and answer as many questions as possible. The difference between this webinar and previous webinars, there's that much more time included in this webinar. We have an hour and a half to go through all the work that I have set up for you, but then also to answer questions. So I want to make sure this is as interactive as possible, and that's a big feature of my webinars. I like to keep them interactive. It really helps with the two-way learning process. Okay? So let's discuss what we're going to look at. So everything you're looking at on the screen right now is what we're going to cover. The first point is a fast track to Japanese candlesticks. We're going to look at Japanese culture. Just a quick point about the Sakata exchange. This is the ancient rice exchange that existed in Japan many hundred years ago. Then we're going to quickly look at how candle patterns or candlesticks have evolved over the centuries. They weren't originally just candlestick patterns. They were actually some kind of a older, different version of chart, which I'll just explain to you. And then at the end of that first session, we're going to look at a quick mention on Sakata's trading success. Sakata is a very well-known and kind of rich, successful Japanese trader many centuries ago that developed his own strategy for using Japanese candlesticks. And I just want to say a few points about that. Then we go into trading lessons. Just a quick point about volatile markets, why these volatile markets that we're in need certain types of trading strategies, specifically Japanese candlestick patterns, which is very popular during volatile markets. And then I would like to make a few points about overcoming challenges and big misperceptions on candlestick patterns, which I think a lot of people have in the market. Lastly, we're going to focus, actually most of the time, focusing on beyond the basics. So in the webinar I gave a while ago, we covered kind of a lot of the very kind of step 1, step 2 candle patterns. I will still go over things in a fast overview manner, but I do want to go beyond the basics in this second more comprehensive webinar and speak more about how you can fast track your learning and your application. And so what we'll do is focus on leveraging candle groups. These are groups of candlestick patterns, so a quick way to memorize all the various candlestick patterns that exist in the market. Then we're just going to have a very easy counting lesson, 1, 2, 3, and how each of the candlestick patterns can be fitted in within each of these time durations, 1-day patterns, 2-day patterns, and 3-day patterns. Of course, we'll look at a few market examples. And then lastly, why context really matters. Knowing all of these candlestick patterns isn't going to be the secret to your success by itself. You need to do a lot more than that. And context of any technical signal is really critical. Okay? So that's basically what we're going to cover. Fast track to Japanese candlesticks, trading lessons, and beyond the basics. Let's start. So I always want to start with a picture. Picture speaks 1,000 words. And the first slide is just basically showing you what a bar chart looks like. And I'd like to ask the question for each of you in this forum, how many people here actually use Japanese candlestick charts? You can just say yes if you use Japanese candlestick charts. Can I just take a quick vote? That's fantastic. Almost, I don't know if some of the team at FX Street can just take a visual snapshot of the chat room right now. We've got a huge number of yeses and probably 2 or maybe more no's. So it's quite a good survey in favor of candlestick patterns. Many people, almost 95% or so of people in this chat room, we have quite a few in this chat room, use candlestick patterns. And that is very much testament to the success of candlestick patterns. And also the application in all the mainstream software and all the educational material that's available out there. Now, one of the points that someone just made now, which is absolutely true, most FX traders use Japanese candlesticks, and this is a point that I really want to kind of emphasize for all of you that are looking at FX rates on FX traders, looking at FX Street. FX, the best way to trade FX, one of the best ways is to actually look at candlestick patterns. Someone has a question on Heikinashi. I will go back to that probably at the end because it's an intermediate question. I just want to get started with the material first, and I'll come back to you on that. Thank you very much. I'll get back to the question on Heikinashi. Okay, so my question here is, just here you're looking at a bar chart, and I just want to quickly go from bar chart to candlestick chart. Bar chart to candlestick chart. I just want you just to quickly kind of sit there, meditate for a moment, look at the screen, bar chart, candlestick chart, and just ask yourself the question, what am I seeing? What is the bar chart telling me? What is the candlestick chart telling me? Now, I'm not going to ask you for the answer. I just want you just in your mind to kind of ask yourself psychologically the differences between bar chart and candlestick chart. Now, I will probably just kind of say 1 or 2 differences. The first difference is, the bar chart, you still have all the price information, the open, high, low, and close. But of course, the difference is when you switch into candlestick charts, you get the colors immediately stimulating your eyes, allowing you to distinguish between buyers and sellers, demand, supply, bulls, and bears. So straight away, the color coding allows for quick identification of buying or selling pressure in the market. Now, can anyone tell me what else does the candlestick chart tell you that maybe you don't see on the bar chart? So some people are saying candles tell a story. Another person said it tells a price pattern. Anything else? Now, previously when I asked that question, I had one person who basically said candlestick charts offer a kind of third dimension. You're able to see the 4 data points, the open, high, low, and close. But you're also being able to see the sentiment in a much different way. It's almost like you're literally allowed to see the emotional health of the market. Now, that's just a quick kind of visual reasoning for why candlestick patterns are more superior. And now I want to go on to other points. Let's go into the history. So, brief history of candlestick patterns. Most of you already know that this is one of the oldest methods of technical analysis or even chart analysis known to the financial market. It's over 400 years old. So if anyone wants to know how old technical analysis is or financial analysis, it is well over 4 centuries old. And of course, it originated in Japan. And at the time, one of the oldest exchanges was a rice exchange called the Sakata exchange. It was a rice exchange based in Osaka. I should say the Osaka exchange, which is a famous, until this day, a famous commercial district within Japan, which became famous for kind of commercial industry, but also the rice exchanges back then, many centuries ago. Now, of course, having an exchange similar to the stock market or any other market, people needed to trade, whether it's commodities, FX, or stocks, people need to trade. And back then, what a lot of people maybe don't realize is that rice wasn't just a food commodity. It wasn't just something that people had for breakfast, lunch, and dinner. It was actually a medium of money, medium of exchange. So if people wanted to actually buy something or sell something or even get paid salary, they would get paid in rice, sachets of rice. So rice was very important. It was as important as money is today or credit cards are today. And so for that reason, it became a very lucrative market to analyze, trade, and obviously try and make profits in. And the rice farmers of the day would do this on a daily basis. What they would do is they would focus on market psychology. Of course, that was the first starting point for them, understanding that emotions drive the market. But also, one of the points that maybe not so many people are aware of, because they were looking at commodities, because they were looking at crops, they obviously had to have a good idea of cycles, and specifically seasonal cycles. So the same way if you're looking at corn, wheat, sugar, cocoa, any of these agricultural commodities, weather really affects these markets quite a bit. And most traders and most analysts, certainly farmers out there that are directly impacted by these weather cycles, need to know the different changes of season and how that might affect price movements and, of course, supply. So they would look at market psychology and seasonal cycles. A lot of the patterns are widely based on military tactics. Japan, kind of being an isolated island of now and back then, took part in many wars and had to defend itself from many countries. And so a lot of military terminology is borrowed and used onto Japanese candlestick patterns. So you will hear like things called the 3 white soldiers or various other patterns which allude to military tactics. Also, you'll hear a few candlestick charts candlestick terminology which might have some kind of spiritual points. So as part of the kind of spiritual nature of Japan, the Buddhist nature of some Japanese people within Japan sometimes also spills through into the Japanese pattern terminology. So look for these kind of funny and magical names in candlestick patterns. A lot of people kind of find them interesting. Some people find them amusing. But keep in mind that the names have a meaning and they do tell you something about the candlestick pattern. Lastly, remember that most of the trading signals are contrarian. And this, to me, is actually one of the biggest selling points in candlestick charts. Most of the patterns tell you when a market is going to reverse. Everyone clear on that? Candlestick patterns, about 80% of them anticipate market turns. So in a market, and I'm going to repeat this several times throughout this presentation, in a market which is volatile, such as the market that we've been in since 2007, since the financial crisis, a market that is volatile tends to have a lot of reversals within that market, tends to be more of a trader's market, looking for swings within the price chart to trade. And candlestick patterns, offer a lot of very useful turning point signals in those type of market environments. So you do get an advantage over other traders that maybe don't use candlestick patterns or maybe don't use candlestick patterns as well as they can do. Now, just want to make a quick point about this person which I mentioned called Sakata. Of course, being 400 years ago, we don't have a photo of him, but this is a cartoon artistic picture which I like to use as a picture of potentially what he or others in his situation would have looked like back then. A humble, simple farmer merchant who rose through the ranks and then was awarded the wonderful title of samurai, mainly because of all the money that he made for himself and for the government, and of course because of the prestigious experience that he built up over the years. Now that particular person was called Sakata. There are various names, different versions of his names, but Sakata is one of them. If you check this on the websites or check in various books, you'll learn more about him. But a lot of people forget the history of Japanese candlestick patterns, and maybe aren't told the use of the history. So the reason why I include just a little slide on this particular person, one, because he's a highly successful rice trader, so maybe there's something we might want to learn from him. Two, because to understand his analysis, it focuses on this classical technical analysis, market psychology, but I want to make the point that he did look at cycles, and that's a big area that I look at. So for some of you wanting to know how I use candlestick patterns differently, I use candlestick patterns with a lot of cycle analysis, and for any of you who look at cycles, I would encourage you to do that. And then lastly, he actually had his own developed proprietary strategy. Not a lot of people maybe, again, have researched this or read about this, but he did have his own way of trading candlestick patterns. And one thing I really want to stress several times that he stressed, candlestick patterns should never be traded alone. Is everyone clear on that? Candlestick patterns should never be traded alone. And I'll say it one more time again. Candlestick patterns should never be traded alone. You should always use candlestick patterns in addition to many other techniques. It's a major hazard. It's very dangerous to just use one technique, any technical technique in isolation, but specifically candlestick patterns, and I'll explain why. But is everyone clear on that? Just that point I just made now. And so the reason why Sakata was such a successful trader many centuries ago in Japan is because he had his own successful strategy in profiting from Japanese candlesticks. Okay. Now, some people are kind of, while I'm explaining the success and history of this person called Sakata, are making very kind of good visual recognition of the cartoon, and I do encourage you to kind of visualize what's on that cartoon. Can anyone tell me any kind of patterns that they can see? So one person says they can see a hammer pattern right there. You can see that there's a hammer actually next to him, but there's also a hammer pattern on the chart. Can anyone see any animals in the background? Hanging man, there's actually a hanging man right in the background. There's a bull and a bear. So it's a little kind of fun visual exercise that we do every day when we're looking at charts, but this is just more in the picture. These are the subtle intricacies that we look at when we look at the market, and this picture maybe helps remind us of that. Okay, now let's talk about candle evolution. Like I said before, candlesticks were never candlesticks actually were not the original type of chart pattern. There were other older charts that actually started out as a candlestick chart. So what I'll do is I'll show you what the original charts were before candlestick charts were invented, so that maybe you can get a better understanding of the history, but also a better understanding of how we got to this point where we started to look at real bodies and shadows, which is the main kind of strength of candlestick charts. So first charts that we had were actually called stopping charts, and they only included the closing price. So we would just look at the price of, let's say, yesterday, the day before, and the day before, and we would just basically plot out those charts, those closing prices. So many, many years ago, people only looked at closing prices, and they were called stopping charts. Then people realized that maybe there was some other information that might be useful, and so they decided that the extreme range, price range of the session of the trading day would also be useful. So they would look at the session high, the day high, and the day low. And these charts were called pole charts, just because it kind of illustrated, kind of looked like a pole, a flagpole, if you will. And the data there, they would look at the high, the low. They actually dropped the closing price for some reason, and they were just looking at the extremes of the day. So what the lowest price was, what the highest price was. Then, of course, they decided, wait a second, let's put the closing price in so we know where the real commitment was in the market, where people decided to end the trading session. And then further on, they added the open price in. So they had 4 data points: open, high, low, and close. And this chart was called an anchor chart. Anchor chart because literally it looked like an anchor, or a ship or boat anchor. And of course, Japan being an island itself, the fish industry is quite an important and large industry. And so anchors were, or fishing anchors, shipping anchors, was quite a kind of a quick and easy way to kind of visualize and trade the market. Now, the way that the anchor is pointing, so whether it's pointing down or up, allowed people to understand whether the market was actually rising or falling. So that's how people would just distinguish between buying in pressure or selling pressure in the market, by the position of the arrow. So you can see here the market opened and then closed down, and the direction was down. And then, of course, later on, actually, I think it was in the late 19th century, maybe, late 19th century, I think most people agree with that. We then actually had the candle chart that we now use every single day, where you basically have the same 4 data points, open, high, low, and close, but the difference is now you have color coding. Now you have an outline, a rectangle outline between the open and the close, but you have a color coding of that, either black or white traditionally, to know whether it's buying or selling pressure. And of course, traditionally, the color black is selling pressure, and traditionally, white is buying pressure. Okay, so that's just a quick snapshot of the history. Everyone okay with that so far? Any questions? Just good general knowledge and appreciation of the history of candlestick charts. Now keep in mind that the charts which the Japanese used 400 years ago actually weren't candlestick charts. They actually used earlier versions of the charts that I'm showing you here: stopping charts, bar charts, anchor charts. Candle charts actually came quite late on. But of course there were many other additional trading techniques, Japanese techniques, which they used, which actually made Japanese candlestick charts quite useful. Some of those techniques were actually forgotten over the centuries, partly because Japanese candlestick charts became so popular, and so people started to focus on candlestick charts, but maybe forgot some of the strategies which, in my opinion, became quite useful, or are quite useful in today's market. Okay, now the reason why Japanese candlesticks are superior to any other trading technique are the following reasons. One, visual. I've made this point several times. I'm a very visual person and technical analyst. I like to see the trade setups on the screen. And visually, candlestick charts are a lot more stimulating when we're actually looking for trade opportunities in the market. The color coding, the price patterns are much easier to identify. Secondly, timing, and this is probably the second or first most important point. Timing in the market is critical, especially when the market is volatile. And keep in mind that candlestick patterns give you signals in a very quick space of time. You can get a candlestick pattern signal in 1 day, 2 days, 3 days, if you're looking at daily charts. If you're looking at intraday charts, of course, you can look at 5 minutes, 15 minutes, 60 minutes, 120 or 240 minutes, whatever time frame you're looking at, short, intraday, short-term, medium-term, long-term. The point is you can get it in 1 trading session, 2, 3, 4. Think how long it takes when you're looking at a chart pattern to develop, or a trend line to confirm. Some of these patterns, some of these trend lines can take several days, several weeks, even several months to actually form. So keep in mind that candlestick charts are leading indicators. Of course, it is primarily based on price. So of course, it is a leading indicator because it's focusing on price, not any other derivative of price. But secondly, the time it takes to actually get candlestick patterns appear on the screen to actually encourage you to make a trading decision can be as quick as 1 trading session. Now, before I just finish this slide, I just want to quickly answer a question. Someone's asking which time frame do you use personally? I use multiple time frames. One of the keys to having a successful strategy in the market is using multiple time frames, and of course diversified trading techniques. So I look at long-term history for my big picture perspective. I like to look at lots of price history so I can determine market cycles. Once I do that, I then drill down from a kind of top-down macro-micro perspective. So I drill down from a big picture to a smaller picture. And then I look at medium-term, short-term, and intraday. So in short, my answer to that question, which time frames do I look at several time frames. I start with long-term, then I go into medium-term and short-term. And yes, I do look at intraday as well. So I will look at 15-minute charts using Candlestick for my timing opportunities. And then, of course, daily charts are probably the most useful. Keep in mind that many years ago, the Japanese strategists and traders only used daily charts. They believed that daily charts actually showed the real psychology in the market because there is a real open, there is a real close. Keep in mind that intraday chart, obviously, what is the close? What is the open? Because it's a rolling market. And weekly, remember that weekly and monthly charts are generically averaged out. The Friday close, the Monday close. So some people do believe that maybe weekly, monthly charts don't give you the most accurate open and close data, and so price psychology in the candle pattern. I use all time frames. I'm just letting you know what the different arguments are out there. So the selling points are visual candlestick charts, so they're visually useful for identifying trade setups. Timing opportunities, it's a leading indicator, can give you a signal in one trading session, intraday, daily, weekly, or whatever time frame you're looking at. Keep in mind that will give you an edge in volatile markets and against maybe other traders and investors that maybe are using other techniques and not this technique. And lastly, remember that candlestick charts use the exact data that you use on a daily basis. So they look at the open, high, low, and close data. And what that means is, if you're looking at bar charts, if some of you who are looking at bar charts, you're not looking at candlestick charts, keep in mind that you're not losing anything by switching from a bar chart to a candlestick chart. All you're doing is switching from one chart to the other. You can still use all the various technical analysis techniques that you use, patterns, trend lines, or things esoteric like Elliott wave analysis, or various other types of analysis. You can still use all of those overlay trading strategies, but all you need to do is just hit that button and switch from bar chart or any other chart to candlestick chart. You're not losing anything, and if anything, you're gaining a lot more. Okay, is that clear to everyone? Okay, so they're the selling points. Visually appealing and easier to identify price patterns. Leading indicator offers you market timing, and they help you enhance what you already use just by flipping from a classic chart to a Japanese candlestick chart. Now, we've covered the kind of first section, the fast track to Japanese candlesticks, and now I want to focus on just trading lessons. Within that, we're just going to focus on two things. This whole point about volatile markets, which I'm very, which is very important to me, and then certain lessons that we should take into mind about volatile markets, and then lastly, certain challenges and misperceptions that a lot of people, including me, had or still have with regards to Japanese candlestick trading. So we're going to look at volatile markets and challenges and misperceptions next. Now, volatility. That's what it looks like basically. This is an old chart with a rate of change underneath there in red, the histogram down below. And of course, another way of looking at volatility is just the statistical way. So a lot of you that have maybe statistical kind of academic backgrounds or any economic backgrounds would recognize this chart. This chart is illustrating a probability distribution. So the chances of anything happening in the market or in life or in anything And basically, this distribution shows you deviations at any time in the market. Now, the line down the middle is the average price. It's the mean. Anything to the left or to the right is a deviation. Anything in the middle part, the midsection of that probability distribution, is a normal price movement, a few standard deviations. Anything which is kind of following this blue arrow to the left or this blue arrow to the right is extending into what we call fat tail territory. And that just basically means very, very big swings in the market, very high volatility, and what we know is market shocks. So things like the 2007 financial crisis, the technology crash, the 1987 crash, and so on. Or just like, for example, when the US stock market sold off very sharply not so long ago. Or, for example, the Japanese yen after the earthquake hit the country, and the Japanese yen and various other markets sold off quite sharply because of event risk. So these are all kind of illustrated on the probability chart. Okay, so that's volatility. I'm just explaining volatility from a statistical point of view. Is everyone clear on this diagram? It's just a quick overview point. Going to move on now. Okay, now how does this actually affect your lives on a day-to-day basis? Why does this matter? This matters because volatility changes through over time, and this is a long-term chart of the U.S. stock market between 1929 and 2011. I put 2012 there because it's certain cycle analysis, which I do. Okay. Now, there's quite a lot of analysis on this chart, so if you can just focus on cycles, the bullish cycles and the bearish cycles, the positive cycles and the negative cycles. That's all I want you to focus on. The red squares and the green highlights. Now, what it shows is that long-term cycles exist, and they definitely exist in the stock market. These long-term cycles can last multiple years, generational cycles. So for the entire generation of our profession, if you think about it, 16 to 20 years on average. And you can see there that most recently, the bearish long-term cycle that most of us are already thinking that we're in started in 2000 in the technology crash, and some people believe will extend into 2012, maybe slightly longer. And of course, during that time, we had the technology crash, and then more recently in 2007, we had the financial crash. Before that, 1982 to 2000, we had a bull market where a lot of markets were rising, a lot of cash was in the market, a lot of good credit. And then before that, various other cycles. Now, is everyone kind of just okay with the idea of cycles, long-term cycles that exist? They alternate from bullish to bearish. Now, the point I want to make is once you realize the long-term cycle, positive or negative, the next question you should ask yourself is, which techniques should I be using in these environments? Now, can anyone tell me what techniques would be very useful in the environment between 1982 to 2000? Can anyone tell me between 1982 to 2000, this section here, where it was a very kind of strong trending market, what type of strategies would have been useful, would have been successful? Can anyone tell me? I'll wait just a moment or two, just for anyone just to voluntarily. Trend follower, yep. What type of indicators would be useful? Yep, you would buy on the dip, so absolutely, very, very good answer. So you'd be following the trend. The trend would definitely be your friend. If ever there'd be a correction, you would just buy on that dip, on that pullback. And then maybe you'd be using moving average indicators, and whenever the market moved above the moving average, you would buy. Whenever the market moved beneath the moving average, you might kind of exit, or you might lighten up that trade that you're on. So maybe strategies were slightly easier, slightly more predictable, and certainly if you think of the pension funds or the kind of very long-term buy and hold strategies, they were quite successful during the green periods, during the long-term positive bull cycle. Now, I'm going to ask you the opposite question. During the periods sideways to negative periods, let's say 2000 to 2011, and maybe 1966 to 1982, these are very volatile markets. What would you say is more useful then? So the first point, people said that trending markets, you'd be a trend follower, the trend is your friend, you would buy on the dips, you might use indicators such as moving averages. What would you use during volatile markets? What is important during volatile markets? Can anyone tell me? Stay away or range trade, absolutely. So cash is king. Sometimes not trading is actually a good decision because at least you're protecting your capital. Absolutely. Oscillators are very useful. Oscillators are very useful, so indicators that tell you when the market has reached an extreme, overbought or oversold, because during volatile markets, of course, you will get a lot of price swings, and the market will reach an extreme and then turn, reach another extreme and then turn again, and it'll develop what we refer to as price swing opportunities, or what some people refer to themselves as swing traders. And of course, candlestick charts are very useful. So someone's asking now, so now we face a big downturn trend for the last 20 years after wave 5. I won't answer that question too specifically. That's for those of you that follow Elliott wave analysis, I've annotated this chart with classical Elliott wave macro big structure numbers, but these are based on the analysis of Bob Prechter at Elliott Wave International. For those of you that follow his work, he's one of the kind of very widely respected analysts, Elliott Wave analysts, and his long-term view of the Western equity market is quite bearish, and so that wave 5 in 2000 is a bearish signal for him. So I just kept that on from previous analysis that I did, but I won't spend too much point on that point. So keep in mind that there's a change of strategy in markets which are trending most of the time, and then markets which are actually quite bearish and quite volatile. Is everyone clear on that? Yeah? Just get a quick kind of yeses in the chat just so I can know that everyone's following me okay. Great. Okay. Thanks everyone for being interactive and for answering me. It just really helps me just to know if I'm connecting with you guys or whether I need to repeat anything again. Okay, so long-term cycles, bullish cycles, bearish cycles. This is a real-time historical example of how they exist in the stock market, the US stock market, and you can see that these long-term cycles last between 16 to 20 years. They are generational cycles, so literally they will last for the entirety of your professional career. They will impact economic and social change within the world. But more than that, on a very kind of important point, a trading point, the strategies that you choose during these environments is critical. So during trending or bullish markets, long-term bull cycles, trend following strategies are best. You would buy on a dip, you would use moving averages, and if you would get a strategy wrong once, twice, 3 times, it's okay. You could get back in the market and not lose too much. The exact opposite is true of a volatile market where you get a lot of market shocks, a lot of volatility, and then market timing becomes more important. Risk management becomes quite important. And then obviously using various strategies like oscillators, overbought, oversold signals, and also candlestick patterns. Yes, so a lot of people are saying I'm talking about time frame which is far greater than the ones most people use. I agree. This is just more of a kind of a long-term, big picture example. The next slide is going to be for all of you, including me, who trade the market on a daily basis. And this is the example here. So these are daily charts. Everyone with me now? So I was showing you just a long-term chart, just so I wanted you to see the big picture. I really think it's useful to look at the big picture. We don't always look at long-term history all the time. So I'm switching from long-term history now to very short-term tactical trading ideas. And here we're looking at daily charts. We're looking at 4 different types of charts. And what I've called this is, different market or trend personalities. I'm glad you like the long-term prediction. We can talk more about that later on. Or if you shoot me an email, I can talk more about that. Okay, so here is a quick exercise. I need everyone to kind of just engage themselves onto these charts, 4 charts. Now, the first 2 charts, chart 1 and chart 2, are trending markets. So chart 1 and chart 2 are trending markets. They are both examples of markets which are rising. They have high highs and high lows. Now, chart 3 and chart 4 are probably closer examples of markets which are ranging. So we're basically looking at 2 types of market situations. Example 1, the market is trending. Example 2, the markets are ranging. What is the big difference between these markets? So between the trending examples 1 and 2 and the ranging markets 3 and 4, what is the big difference? Can anyone tell me? Okay, so the ranging is erratic, absolutely. Anything else? Basically, I mean, the key thing I'll say just quickly, some of you might already be thinking this, yeah, someone's already said it, volatility. That is the answer. So well done, person under the login name of Lana, and also Harley, who said it's volatility, and Harley, who said it's unpredictable. Now, volatility is the key thing, and volatility is actually a great example of market personality. Every market has a different personality, much like your family members or your friends or colleagues. Each one has a different personality, a different characteristic, and this is very true of the market. And this is how I often talk about markets. Now, one of the ways that you can understand the different personalities of a market is by understanding its volatility signature. Something which was a big point that a very famous analyst called William Gann spoke a lot about in the 1930s. He was a big advocate of volatility and how different markets had different volatility signatures. Now, there's a probability of success, as someone's saying here, in each of these markets. Now, obviously, if the market is trending and stable, like market number 1, your probability of success is probably quite high because volatility is low, the market is quite calm and quite predictable. You can use a moving average to follow the trend, a 20-year moving average or a 200-year moving average for short-term to long-term opportunities. And whenever the market crosses above, if you're buying, you can buy. If it crosses below, if you're selling, you can sell. It's quite a simple strategy and potentially successful strategy in example 1. Of course, if you get whipsawed or if you get big corrections during that time, because the market is quite calm, you can still survive. You can still probably maintain your profit run during that time. Now, can anyone tell me about the difference onto chart 2? The chart 2 is still an uptrend, but of course, the difference is you have higher volatility, larger volatility. And so this is what I explain as kind of heart attacks in the market. Each of these corrections, each of these drawdowns are heart attacks in the market. So it's kind of, think of yourself as walking across the road. You're still walking in a straight line, but then as you're walking down the road, you have a heart attack every 5 minutes. You're still achieving your objective to walk across the road, but along the way you have these kind of sharp pains, which emotionally are quite challenging to manage, and obviously physically. And this is the point. So I can show you many examples of profitable trading strategies that would have worked in the past. But the real point is, would you have been able to actually do that in real life in terms of managing the risk and managing the capital that you're trading? You're right, traders don't have heart attacks. I mean it just metaphorically. I'm just using it as an example. But does that help just understand how cycles are quite important? I showed you the long-term cycle on this chart here, but then I'm showing you how long-term cycles actually will affect medium-term and shorter-term cycles by affecting volatility. And of course, one of the points that I'm going to be making to you again and again and again is that in chart 2 and chart 4, you get a lot more volatility, which means a lot more price reversals, price swings, and during those times, you'll get a lot of candlestick pattern reversals. Remember I said roughly 80% of candlestick patterns are reversal patterns. So just by definition, using candlestick patterns and knowing those signals really well, knowing them, memorizing those signals will really help you in today's market, whatever time frame you're looking at. whether it's intraday, daily, or weekly. And of course, whichever market. Now, someone's asking, are scalpers more likely to succeed in highly volatile markets to get in and out swiftly as possible? Some people, I would say yes, that they can have successful strategies. It all depends on what they do, but yes, that there is a lot more kind of short-term strategy in the market at the moment. Certainly a lot of algorithmic trading, which is actually focused on millisecond or milli-minute trades, and so a lot of that is happening. Why does 4 not have any wording? That's a mistake on the presentation. Yeah, it should be ranging and volatile. So chart 4 should be ranging and volatile. Yeah, everyone kind of clear on that? We're just looking at basically market cycles, long-term cycles, how they affect short-term and intraday cycles that we trade on a daily basis. And most importantly, ask yourself the question, what type of trading techniques should we be using? Even right now, the market is more volatile than other times. You will see trends in the market, but those trends will tend to be limited. You will tend to get false signals as well, false breakouts during volatile markets. And so, really kind of advancing your trading strategy is very useful and very important. Candlestick patterns are is a very important tool to use during volatile markets because of the reversal points that take place in a volatile market. But in addition to that, you need to really focus on risk management and money management. Okay, so now we're going to focus on candlestick patterns themselves in the remaining kind of 30 minutes that we have here. I want to spend the rest of the time focusing on candlestick patterns itself. Thank you guys for positive feedback on the strategies. This is purely a session on Japanese candlesticks, but I over the years that I've spent in the market, and especially the time that I've spent working at Bloomberg, training many people in banks and hedge funds around the world on trading techniques, I've realized that a lot of the time is better spent actually talking about application and context of any technique. Now, I'm a specialist in candlestick patterns, but I really believe that step 1 is actually understanding the application of a trading strategy and then understanding the various candlestick patterns, because it really speeds up the learning, but also the success of using this trading technique. Okay, so we're going to look at beyond the basics. All of you should have a working knowledge of Japanese candlesticks. Please feel free to watch the previous webinar, which is recorded on FX Street, where I gave more of a comprehensive step 1 beginner's guide, or try and read some of the books out there which have been published on Japanese candlesticks. There are many books, and some of the famous, well-regarded ones were written by Steve Nissen, who championed Japanese candlesticks back in the 90s when he introduced it to the West, and another person, Greg Morris, that looked at a lot of systemization of candlestick patterns. So Steve Nissen and Greg Morris are two very highly respected candlestick pattern experts that you can read books and literature on. Everyone clear on that? I should have actually started on that point, but just keep in mind that if you want to go over some of the detail, those are very important individuals to follow. And I will come to Heikinashi right at the end, hopefully. Okay, so beyond the basics, I want to talk about leveraging candle groups and Bigelow, yes. Also a more recent expert, but certainly a person that has published many useful books on the subject. Steve Bigelow, he also has a website for those of you who are interested. Okay, so I'm going to look at leveraging candlestick groups. Then I'm going to look at the various patterns, of course. We need to learn some of the patterns, but I will try and teach you how to learn the patterns very quickly, and most importantly, how to remember the important patterns, because remember, there are many, many, many patterns out there. And then lastly, context. I'm going to end on probably the most important point that may actually be worth all of your time in this webinar. Just this one final point that I talk about in terms of context of candlestick patterns. Okay? So let's get started on the final part of this session. Now, I want to go over basic candles. Each of you should know, all know about these candlestick patterns. These are just basic candles. Long candle here. This is a strong buying session, strong selling session, white and black. The middle of that candle, the midpoint or the pivot point, is a very useful support resistance level. So I'm going to keep dropping kind of useful information or some kind of experience tips for you. So please feel free to note this down if it's of interest. Big candlesticks are very important. They tell you a lot about maybe potential breakouts or potential rallies or sharp selling in the market. But the middle of that range is actually quite useful, especially for intraday trading. Doji is basically where the market open and close is either the same or narrow. So the market opened, pushed up, pushed down, but then closed exactly where it opened or near where it opened. And basically it shows that the market is tired or there's indecision. There's a little kind of gray psychology in terms of which direction the market wants to move. Then there are variations of the first two, spinning top and high wave. Spinning top is basically where you have a small real body. The open and the close has a small kind of spread difference between the two. And this just shows that the prior trend is weak. And then lastly, high wave looks like a spinning top, but the difference is the shadows, the long lines, are basically showing you volatility in the market. This indicates confusion, basically. So whenever you see this, it just shows you the market opened, pushed really high, pushed really low, and then closed in the center or near the center. So it just basically shows you that there was a lot of volatility, big price swings, and in the end the market kind of closed near the average of the day. Okay, so now we're going to switch on to the actual candlestick patterns. And the key thing to keep in mind is there are many candlestick patterns, over 100. Keep in mind over 100. So the first really quick secret to success I'm going to share with you, which took me a while to learn in my experience. I started by memorizing every single candlestick pattern which existed. You can try and do that. It's a very long way to learn, and sometimes it's very boring, mechanical, and usually it's quite off-putting for people. So a lot of people decide not to use candlestick patterns because they're not too happy about the fact there are so many candlestick patterns. Remember, 100 different candlestick patterns. So one of the quick ways that you can fast-track your learning in identifying these patterns and obviously trading off them ultimately is by realizing that each of these patterns fall into categories or family groups. So if you just think of two groups, as you can see here, reversal patterns and continuation patterns. Reversal patterns, continuation patterns. Now remember I said almost 80% of candlestick patterns are reversal patterns. So point number one, straight off from the top, before you learn any candlestick pattern out there, just realize they fall into two categories, reversal patterns or continuation patterns, and the reversal patterns account to over 80%. Is everyone clear on that? So straight away, you've just cut through a lot of information, and you've made a very kind of important understanding point. The other point that you need to keep in mind is that each of these patterns fall into even smaller categories, time categories. So how much time did it take for the pattern to form? So for example, this list is the one-day category, the family of one-day patterns. Everyone clear on that? A long candlestick, Marabouzo, Doji, hammer, inverted hammer, shooting star, hanging man. Everyone okay on the point I'm making? So this list here, which I'm circling with the mouse, is a list of one-day patterns. Then we move on to two-day patterns. Two-day patterns, so you can see here, engulfing, harami cross, dark tag clover, and so on and so on. Continuation patterns, rising window, falling window, separating line. Everyone with me? Okay, and then finally we have 3-day patterns, 4-day patterns, even 5-way patterns. Can everyone see how this is just so much easier now? Suddenly you just look through the microscope and just seen through all the noise, seen through all the trees in the forest. Okay, so straight away, whenever you pick up a candlestick book, or whenever you see any candlestick patterns from now on, just please promise me that you will just look at this idea of dividing it into groups. First of all, two groups, reversal patterns, continuation patterns, and then smaller groups of time groups. So how long does it take for the pattern to develop? 1 day, 2 days, 3 days, 4 days, 5 days. Now keep in mind, they don't have to just be days. It can be, for intraday trading, minutes. For daily trading, days. For weeks, weeks. So this can be any time frame that you look at. Is everyone clear on that? Okay, great. Now I'll go on to the Doji pattern. This is the most popular pattern. So a lot of people trade the Doji pattern because it's very easy to identify. And I'll just remind you, it's when the open and the close are the same, or they're narrow, that they're very close to each other, and it shows you that the market is tired. Now I'm quickly going to show you an example which I showed in the previous webinar, because it's such a good example and because it allows you to kind of really kind of think about what I'm teaching you. I'm going to show you an old market example of silver with many Doji patterns. So please focus on the Doji patterns and the variations of Doji patterns here. This is a Doji, this is Doji, this is Doji, and so on, but these are different types of Doji. Now, in this chart here of silver, very old chart in 2004, please look at the price rise after this arrow. On the right side of this arrow, how many Doji do you see on this chart? Do you see 1? Do you see 2? Do you see 3? Do you see more? I can get a quick survey, please. How many Doji do you see in this chart? So I need to do a quick survey. So we have quite a few people in this chat, so please feel free to throw in the answers. For those of you that did attend the previous seminar, feel free to kind of give me the answer, but if you could let others share the answers as well. Okay, so some people are saying 7, 7, 3, 6. Anyone else? Another person saying 1, 6, 2. So there's quite a few answers there. 3. Okay, so and carry on, please. If each of you want to give an answer, it's fine. Just so you can feel that you've given some kind of contribution to this webinar. Please feel free to just put a number in the chat while I'm explaining this chart. So if everyone in this chat room can just please give an answer, just so you've committed yourself to an answer of some sort. Thank you. Thanks for the interaction, everyone. Okay. Now, there are many. I'm showing you the answer now. You have 1, 2, 3, 4, 5 Doji patterns. Now, of course, some of you may agree or disagree with me because it's not an exact right or wrong example that I'm showing you. What I would like to make a point, though, there is a good point that someone just made just now, but I'm just going to get onto that. First of all, before we ask about the pattern which I haven't highlighted, which you're absolutely right, I want to first focus on why the 5 patterns I've shown you haven't worked. So most of the time in most presentations, people show you examples that work beautifully. I want to show you examples which work badly, because I think we can learn more actually sometimes out of bad examples than actually good examples, because it shows us the mistakes that can be made in the market, and hopefully if we learn from our mistakes, we can be successful traders and investors. Now, Doji 1 and Doji 2, keep in mind you need 2 things to actually confirm a Doji or a reversal pattern. 1, you need a trend to reverse. So if any of you have a pen and paper, write this down. 2 things you need. 1, you need a trend to reverse. If you get a potential reversal signal in the market, you need a trend to reverse. Second, you need a price confirmation or follow-through of that reversal. So is everyone keen, understanding me on that point? You need a trend to reverse, and then you need a price confirmation of that signal. Now, if we look at this example, Doji 1 and 2, there was no real trend to reverse. We had this kind of soft rising trend, but it's not a very strong trend. Either way, if we look for the price confirmation here, there was no close beneath Doji 1. Yeah? So basically, we closed below here. Session 2, the market rose and basically broke above the resistance line. Doji 3 and 4, so there was no price confirmation of these reversals. Everyone clear on that? Doji 3, 4, and 5, same thing. The market pushed higher after Doji 3, so it didn't confirm that potential reversal. It did actually close on Doji 4, but then again it pushed higher. So again, we had a breakout to the upside. So Doji 1, 2, 3, 4, and 5 are just examples of when a doji is actually telling you not that there's a reversal, but that the market is tired, it's taking a breath. So here I'm working and living in Switzerland. We have many mountains, and I do as much hiking as possible. I still have a lot to do. And one of the things I realized firsthand is when you're climbing a mountain, you start the mountain at the bottom of the mountain with lots of energy. You get to the top of the mountain, you've lost a lot of energy, you're exhausted. And so this is maybe an example, a metaphoric example of what's happening in a market rise, especially when the market accelerates. It starts with a lot of energy, then it loses that energy. But during that time, you get tired, the market gets tired, but it doesn't necessarily mean it's going to reverse. It just means it's going to take a breath and then carry on climbing that mountain. Okay, you're right. 1, 3, 4, and 5 do have small real bodies. So it's up to you what your definition is. The classical definition is the open and the close are exact or near to each other, narrow. Some people will then say it's spinning candle, so it does depend on your own criteria. One thing I do suggest is if you're actually computing candlestick patterns, this becomes quite important. And I did a lot of this when I was working at Bloomberg. I had to try and design a program, help a team design a program on candlestick patterns. And being able to actually quantify candlestick patterns is the next challenge if you were to do that. Okay, now I'm gonna. Can anyone tell me where the final doji is? It's the last one on the right. Yeah, right at the top, the current candle. So the most important candle on this chart is definitely this one. This is number one. It's a classic doji. The open and close are exact, so it's a textbook type doji. Number two. It's at the top. Of course, it's easy to find the top in hindsight when you have the history, but you can kind of see that there's a massive acceleration here in the market. It started at $4.5 and then doubled in price to about $8.50. So it's quite a big move in that period of time. And around this time, you can look at your oscillators, your indicators, and obviously a lot of your readings will be telling you that the market has ever bought. That's quite a natural thing to see at this moment. The other thing is you see that before this doji appeared, you have 1, 2, 3, 4, 5, 6 consecutive rising sessions. This is a point I'm going to make right at the end when we look at gold, because of course those of you that trade and look at gold, or even those of you who maybe have looked at my blog on FX Street, will know that it's quite an exhaustive pattern. So anyway, this is a doji, and then of course we'll get the collapse thereafter. No way to finish. Very good point. I'm going to try and be as fast as possible. Okay. So the key things to keep in mind is the location of the doji pattern. You need a trend to reverse. Keep in mind that if you get a doji pattern or any other pattern in a range, it's very hard to actually get a good signal from that. So the better pattern reversals are the ones where you actually get a price swing or a price trend that gives you a momentum to reverse. Okay. Keep in mind as well that you have different types of structures within the market. You have signals that can appear at a market peak, market dip, or a minor correction, a range, or a key level. Okay. I'm stuck for time, so I'm going to have to quickly speed on because we're running out of time. But just keep in mind that there are different types of setups. I will spend more time on this in the exclusive premium section because that is a second kind of more advanced section where we talk about trading strategy. Okay, now let's look at some of the patterns. I'm going to quickly go through this. So please, if sorry about the time, if we can just focus about some of the patterns. This is a hammer pattern. So it's just showing you a falling market. And then right at the bottom, the market makes a low. Each of you should hopefully know these patterns. So I just want to quickly focus on some of the chart examples. Okay, so this is a hammer pattern. It just basically shows you that the market pushed to a new low, but then the real body was at the top, and so it was hammering out a base. That's the psychology behind a hammer. It looks like a hammer. It's searching for a low in the market, and it's a great bullish signal. It's a one-day pattern. The other pattern looks exactly the same. It's called a hanging man pattern. It's exactly the same shape as the hammer pattern, but the location of the pattern is what's very important. So the location of the pattern is at the top of a market move. You can only find a hammer at the bottom of a price swing or a market trend, a bear trend, and the hammer can only be found at the top of a price swing or the top of a price trend. Is everyone clear on that? Now the hammer pattern is not the most reliable pattern. I'll explain that more in the advanced session. Just keep in mind the problem with the hanging pattern is that you need more confirmation because in isolation this candle pattern is quite bullish because as you can see the market gaps up, the market opens higher and then pushes higher, but then in the middle of the session pushes lower and then closes higher again. So it creates a lot of confusion, and in the end it gives people the feeling that you're still making money. And you need the confirmation, the downside reversal, for this to then become a bearish reversal. Shooting star is basically the hammer pattern but inverted. Okay, so a lot of these candlestick patterns are exactly the same shape, but they maybe are kind of look differently in terms of where they appear in the market, and sometimes when they're actually flipped over as mirror images. So this is a shooting star. Now I'm going to quickly show you an example of a hammer pattern on dollar yen. Can everyone see this? So this is after the earthquake where dollar in March of this year in Japan, when the dollar yen basically dropped about 400 pips in about 23 minutes. Quite a big move, and we're looking at that right now. I personally look at dollar yen on a regular basis. This was quite a big move. And you can see here, obviously, this very big shadow, several hundred pip shadow, showed you there was a massive rejection of downside levels. So there's a big reversal in the market on an intraday basis, all the way up. Okay, so that's an example of a hammer pattern on dollar yen. I will talk more about how to trade these patterns in the advanced session. Second point is so the 2-day pattern we're going to look at, engulfing pattern. Engulfing pattern is actually a very popular pattern that just basically shows you when one trading range engulfs another one. So basically, you can see here this real body here, this white real body engulfs the previous black body. So the bulls are basically taking control of the bears within this reversal. Okay, there's a larger body that engulfs a smaller body, and this is an example of a bullish engulfing. The opposite would be a bearish engulfing if you see it at a market top. Another candle pattern is called a dark cloud cover. It's basically shows you a market rising, but then the market gaps higher, so it opens higher on the next session, and then straight away pushes down halfway into the prior session. So basically, a lot of people have been making money in this rising market, but then right at the top, they literally lose about 50% of their daily profit, or maybe 2 or 3 day profit, in a very quick way, and that creates quite a dramatic reversal. And a lot of the time, it is literally a reversal of sentiment. These can be quite powerful signals. Dark cloud cover. Keep in mind that the symbology here, dark cloud, is just an example of something that is bad whenever the dark cloud appears. So a lot of the candlestick names have symbolic names. Engulfing pattern happening now on Eurodollar on 4 hour. In the advanced session, I will have a live feed where we will actually be looking at interactive charts. And maybe in future when we do other webinars, I will have live charts running in the background. Okay, piercing line pattern is the opposite of a dark cloud cover. Again, the market's falling, so it's the opposite, market's falling, but then it gaps down, and then all of a sudden buyers appear and they push into the market, and there's a big surprise. Sometimes it's a big news event or a market shock or something. Very good question that gaps in candlestick patterns are treated differently in FX. I'm glad that someone actually asked this question. It's important that everyone is aware of this. FX, of course, is a 24-hour market, so everyone asks the question, what do you do with gaps? Basically, you don't get gaps in patterns in the candlestick, in FX candlestick patterns. So you have to kind of apply your own filter. You can still get these patterns, but you have to adjust what you look for. I'll talk more about that within the advanced session, but it's a very good question. There are no gaps, so the patterns will look differently in FX as opposed to any other market. Okay, and then here's an example of a bearish engulfing on oil. Now I'm showing you relevant examples. Here, this is a current example of oil. I kind of shown you oil trading at $98. This was a few hours ago. But this just shows you the market top in April was actually triggered by a bearish engulfing pattern. And that bearish engulfing pattern produced a really good resistance level. So keep in mind that these patterns don't just give you reversal signals most of the time. They also give you key levels in the market, key psychological points. So this key psychological point then showed you a Doji pattern or a spinning top pattern, which again kind of failed to break above this level, and then you had a massive sell-off. So keep in mind that you're not just looking at one signal in isolation. Remember I said do not use candlestick patterns in isolation. Use it in addition with many other types of analysis. But keep in mind that it will build a lot of kind of useful analysis and success if you use it in addition to everything else. So this is an example of a bearish engulfing, bears arresting control from the bulls, and then this key resistance line showing you how the market failed and then sold off quite sharply. If any of you are looking for bullish signals in oil, we really need to break these kind of key levels, these key peaks, but specifically this level here at the top. Okay, last group of patterns I'm going to quickly show you in the 10 minutes that we have. 3-day patterns. Now keep in mind that anything that takes 3 days or 3 weeks or the number 3 to develop, it is more of a rare event. It takes more time by definition for this pattern to develop, whether it's a chart pattern, a trend line, or a candlestick pattern. So keep in mind it's a more rare pattern. You'll get more 1-day or 1-minute session patterns as opposed to 2, 3, and definitely 4 or 5. And so if they're more rare, sometimes it means that you can get quite impressive moves or maybe reliable moves from these patterns. Okay? Yes, I've missed out 1 or 2 patterns just to keep it focused on some of the key patterns. Now, so this is a morning star pattern. So this is an allusion to kind of astrology. Morning star is basically what most people will say is Mercury, the planet Mercury appearing before the sun. So it's a positive sign of sunshine, of morning time during the day. And basically it shows you the market selling off. Then you get a small body, and then the market starts rallying again. Classically, you should get a gap between these 2 sessions. There should be a market gap. Of course, if you're in FX, you don't see the gap, so you have to adjust your parameters. Now, this is a bullish signal, a morning star pattern. The opposite of morning star pattern is an evening star pattern, and of course, those of you who know Mercury symbolizes morning time. Mercury appears before the sun rises. The opposite is true. Venus appears before dark. So you see the planet Venus appear just before it turns to nighttime, and of course that's a bearish connotation. And here it shows you the exact opposite. The market rises, gaps up if you're looking at non-FX markets, and then you get a big correction down. Notice these red lines that I've highlighted. This is a very useful tip that I'm making. The red line is basically a 50% midpoint line. And that 50% midpoint line is what you can use to confirm an early kind of confirmation of this signal taking form. A lot of people don't like waiting too long for the signal to finalize, because of course everyone else will be trading the same signal. So sometimes it's good to build up a position, or at least to kind of keep a watchful eye on that trading signal. And so that 50% line can be very useful, that midpoint line, for confirming some of these signals, especially the 2-pattern or 3-pattern signals. Is that clear to everyone? Okay, so that's an evening star pattern. And the last one, three white soldiers, very easy. It's basically very strong consecutive buying pressure in the market. So 1, 2, 3, pushing up, 3 white soldiers. And then the opposite, 3 black crows, 1, 2, 3, but on the way down. Of course, black crows are quite a kind of negative connotation, and this is a sign of bad news. in the market. Now, I'm going to show you an example of a evening star pattern on the Australian dollar. I'm currently bearish on the Australian dollar. It hasn't been an easy trade, but one of the key signals for me is the market top in Aussie dollar, which topped around 110, and that shows you an evening star pattern where you had a market rise. Of course, the rise in Aussie dollar was huge over the last few years, almost 70%. And then we had Doji appear, and then the reversal down, and that top has held. Of course, as we hold that top, then somebody may decide to be neutral to bearish on Aussie dollar. Please show so someone's asking if I can please show the fourth on the second day pattern. I'll just quickly show it to you. Second day pattern. I'll say that I can maybe try and email it to you. If you can send me an email, I can send it to you. There isn't that much time, sorry. Okay, so that's evening star on the Aussie dollar. Now, I'm going to show you the last example on gold. I'm going to run over maybe by about 5 minutes, guys. So I hope that's I'm sure that's okay for everyone. I hope that's okay for the FX Street guys. And I will get back to you about US dollar falling from euro dollar falling from grace. Sorry guys, I'd love to really kind of like focus on the market as well, but it's really important that I stick to the agenda for everyone here that's come to learn about the educational use of Japanese candlesticks. Feel free to send me a blog or send me an email. I'm happy to share any information with you. Okay, and I think FX Street have recorded this, so you should be able to watch it again. And if they have recorded it, please feel free to watch it and maybe send to your friends. And of course, attend future webinars that we organize. Remember, the next one is the market indicators in August. Okay, and the email I mentioned at the beginning of the presentation. All of that I promise you I'll put right at the end of this presentation so that you can stay in touch with me as much as you want to. Okay, so 3 white soldiers is a great example for gold. Keep in mind one of the strongest trade ideas, and these are just ideas. I'm not allowed to give trade recommendations for legal reasons at the bank. But one of the trade observations that, for educational reasons, that I do want to make to you is very relevant now, and this is on gold. Everyone looks at gold. Gold is very important to everyone. Keep in mind that, and I've put a very important blog message on Forex Street Network. Please look at that. Gold has risen for about 10 consecutive sessions. So for 10 consecutive sessions, we've had higher closes, and that is a very unprecedented overbought situation. And I've issued like a very important blog on that on FX Street and obviously on MIG Bank, talking about how that has increased the risk of a correction over the next few days. There isn't enough time for me to talk about it, but just keep in mind that the first signal of that breakout was actually 3 soldiers. So we were within this range. I actually missed this trade opportunity because I was actually thinking that the market was going to break below 1460 and push lower. And instead, you had this dramatic reversal on the upside, 1, 2, 3, and then of course it developed into about 10 to 11 other bullish sessions. So keep in mind we can have very kind of strong reversal points, starting off by candlestick signals, which can develop into great kind of price moves. This is a very kind of good short-term trend. But keep in mind that currently I'm more concerned on the downside risks on gold following this unprecedented overbought extreme situation. Okay, I'm going to end off on this. Remember context. Context is, to me, this pyramid. And this pyramid is an analysis pyramid which I designed a long time ago in all the educational stuff that I do at work, but also with educational organizations, societies. And this analysis pyramid is a way to analyze the market from a kind of a macro to micro perspective, a top-down perspective. Remember I told you that I look at the big picture and then I drill down. So this is what you should do on a daily basis. You should focus on, start up top, focus the top of the pyramid, think of trend analysis. What is the trend? What is the cycle telling you? look at the key levels, and then look at the indicators. And when you do all of these three different parameters, once you analyze each of these three areas, then use candlestick patterns. So never use candlestick patterns in isolation. And please, please, please look at, think of this pyramid analysis example of things that you should look at: the trend, the cycles, the key levels, and the indicators to actually confirm the candlestick patterns that you get. Never trade candlestick patterns in isolation. Just finally, any questions that you have, and of course there have been many questions throughout the session that I've tried to answer. Any other questions, please send me an email. It's r.william@migbank.com, r.william@migbank.com, or just follow up on my blog on FX Street. I've put a blog there for Japanese candlesticks. Any charts that you're interested in or any kind of literature I can send to you, I'm happy to do that. Just email me. And then finally, we have an exclusive offer for a 1-month free trial of our reports. We cover the markets, mainly FX, but also commodities and equities and other markets. If you would like to have a subscription to that for 1 month free, let me know. Ron William, technical strategist at MIG Bank. It's been a pleasure sharing this time with you. I hope everyone's learned as much as possible. And one of the key mantras that I always like to end off on is enlightenment to realize knowledge. I really hope that everyone's kind of gained some valuable knowledge from this session. I always learn from the questions that I get, and I hope that you've learned from some of the examples that I've shared with you. Thank you very much for attending this webinar. It's been an honor and pleasure. Thank you, FX Street, for organizing part 1 of Japanese candlesticks. Thank you, everyone.